Hey, Renter Retires, it's Adam Schroeder here with another episode of the podcast. And I am once again joined by Zach Lemaster, the CEO of Rent to Retirement. And we have a special guest with us today. It is Jilliene Helman, the founder and CEO of Realty Mogul and Crowdfunding CEO of the Year. And she was awarded one of the 100 most influential real estate leaders. And Realty Mogul was named the top commercial real estate startups in the country. So welcome to the show.
Thanks for having me today.
Absolutely. Why don't you tell us a little bit about your background in real estate and how you were able to found a company that was named one of the top commercial real estate startups in the country?
So, I joke that it started sort of around the dinner table when I was 2 or 3 years old, but I grew up in a very entrepreneurial family. Dad was an entrepreneur. Mom was very entrepreneurial. A lot of my brothers today are entrepreneurs. And so we were talking about business ever since I was a young child. And my dad owned commercial and industrial real estate for his business. My mom was involved in luxury residential real estate. And so kind of just learned real estate through osmosis. Went to undergraduate business school at Georgetown in DC, came back, went to work in banking, but always knew that I wanted to do something in real estate. So kind of got that foundational financial knowledge and then took off on my own and started Realty Mogul almost 10 years ago.
Nice. And so when you're looking at, obviously you look at the market a little bit differently than we do, since a lot of us focus on single families, but I'm hearing whispers, people are starting to be concerned about what's happening in the marketplace. What do you see happening now? And are you concerned about, the next 1 to 2 years in the real estate market based on, inflation and slightly rising rates and those things?
Yeah, I'd start by saying I don't like to think about real estate in 1 to 2 year increments, right? I mean, I really view real estate as a long-term aspect of one's portfolio. I mean, you can't get in and out of it easily, right? So you don't want to think about real estate like you think about, day trading a stock as an example, just because there's a complete lack of liquidity when you're buying, actual buildings and sometimes, properties that are 20, 30, 40, $100 million. I really believe less in the macro and more in the micro right now. And this was solidified, I think, by what happened during COVID, where you had some micro markets that performed very, very well. Look at Boise, Idaho as an example, right? And you juxtapose that by some markets that really didn't perform well, right? New York City, San Francisco. So it was really the tale of the micro, not the tale of the macro. But you have two competing headwinds right now. You have inflation, and that's driving kind of astronomical rent growth. I imagine you're seeing it in the single family market. We're definitely seeing it in the multifamily market. But you have that coupled with, rapidly increasing interest rates, right? The Fed's just about to meet again. They're gonna raise interest rates again. And so it's this trade-off, right? What's going to be the greater driver? Is it going to be inflation? Is it going to be interest rates? I would say in commercial real estate, there's one other major factor, which leaves me net bullish as opposed to net bearish. And that is just the sheer amount of capital chasing deals. So even though, we're seeing the impact that interest rates are having, you have more capital chasing commercial real estate assets, specifically multifamily, than you've ever had before in the history of real estate, both domestic capital and international capital. And so that's primarily a supply and demand equation, right? There's a limited amount of assets that go for sale any given year, and you've got a ton of capital chasing those assets. So I don't see cap rates, expanding very rapidly, just given what's going on with demand.
Jilliene, you touched on a lot of really good points that I think everyone is very conscious about right now. And really the question comes down to, okay, what's happening in the market and what do you do? We're very bullish on real estate in all market conditions, because there's always a way to be successful regardless of what's going on. With interest rates going up, I mean, the question really is not, or shouldn't it be, what do you do? Do you participate in investing in real estate or not do anything? Because what else are you going to do? It's more or less, how are you going to be a successful investor in this type of environment? When you're just a couple quick questions for you, when you're talking about commercial, is this mainly in the multifamily space? Do you also participate in something like retail, industrial, office, or kind of all the above?
Yeah, so one of the core values of Realty Mogul is to empower investors to build the real estate portfolio that's right for them. So we aim for diversification. We've got apartment buildings, office, retail, industrial, self-storage, mobile home parks, We've done some single family pools as well. We haven't done like a single home, but we've done, pools of single family homes that are being, bucketed together and purchased together, single family rental. So we run kind of across different asset classes. That being said, over 50% of the volume has been in multifamily. So they tend to be larger, multifamily apartment buildings, 100 units, 200 units, 300 units, 400 units, those kinds of sizes. But, again, we want investors to have the opportunity to diversify across asset classes, across geographies, and also across different partners, right? So we work with a lot of different partners across the country that specialize in different properties, in different geographies, and also in different business plans, right? We might work with a developer in, Nashville as an example, and we might work with, someone acquiring an existing industrial asset in California. So the goal is really to get broad diversification and empower investors to make the choice that's right for them.
I love that. Diversification is so huge, not only speaking in different geographic locations, as you mentioned, but also across different asset classes and partnerships. That's immensely important. I love the point that you talked about micro versus economic analysis, because I think a lot of people want to immediately, when they think about a market correction, especially in today's environment, just think back about 2008 and just kind of compare that as like they're almost expecting something like that to happen again. Whereas the reality is it's going to be likely there's going to be market fluctuations in different locations that are handled differently that we've already seen. I mean, a lot of the areas that we specifically invest in our own and with our business are in areas that have thrived throughout COVID. I mean, areas like Southwest Florida. I mean, just politically and economically, they're doing quite well, and we see population trends there. I definitely want to dive into how you vet your partners that you work with, but kind of on a fundamental level for someone that's not familiar with Realty Mogul or even really the concept of crowdfunding. Can you just explain that kind of in very layman terms, what you do and how crowdfunding works?
Sure. So you may have heard it called syndication in the past, where disparate investors come together, they all invest in the same transaction, and that transaction effectively gets syndicated across that network. The concept of crowdfunding is very similar, right? Investors that are coming together to collectively invest in a real estate project. The sort of benefit that we bring is we allow investors to do that on the internet, right? So they don't have to be at the country club, they don't have to go and network. We've got teams in the field in a variety of different geographies that are building relationships with real estate companies in order to expose investors to a lot more access to real estate opportunities than they otherwise would have, right? If you live in Florida, as an example, in Miami, it's probably not very easy to find, an apartment building to invest in Dallas, Texas, an office building to invest in Austin, Texas, an industrial property to invest in California, right? You're unlikely to have that network to sort of get that broad geographic and asset class diversification. So that's the goal, of our platform. And I think the goal of a lot of crowdfunding companies is to give access. But really, it's good old fashioned syndication. It just happens to be good old fashioned syndication on the internet. Do
they have to be an accredited investor? Obviously, there's different syndications with, depending on how it's set up with SEC regulations on, pre-existing relationships, if they're accredited or not. Is there a minimum investment amount?
Sure. So we have different types of investment opportunities that are for accredited investors and non-accredited investors. So on our platform, there's a wide range of opportunities. For non-accredited investors, we have 2 non-traded REITs or real estate investment trusts. Those are open to non-accredited investors. The minimum in those vehicles is $5,000. And then for accredited investors, they can buy into specific real estate properties. So a specific apartment building, a specific office building, a specific industrial facility. And the minimums in those transactions tend to be $25,000 to $35,000.
For anyone that's unfamiliar with what it means to be an accredited investor, do you mind defining that quickly?
Sure. So accredited investors typically will have either $1 million in net worth, excluding the value of their primary home, or $200,000 in annual income if it's an individual, or $300,000 in annual income if it's an individual plus a spouse.
Okay. And so you mentioned, Nashville, you've mentioned Texas, you've mentioned Boise. Where are you seeing y'all's opportunities right now? Because I assume, based on what you've been talking about, you're all over the country. So what do y'all look for in terms of markets that you're investing in, and where are you seeing the opportunities right now?
Look, I think that there's good opportunities in every market, to be honest. It comes down to basis, right? Where are you buying that property? So basis is really important. I think supply and demand is also really important. I mean, you've definitely seen that the Southeast has been one of the hottest places to invest, right? And we've seen a lot of production and a lot of business in the Southeast. We've been doing a lot more in Florida. So, the rental growth rates in Florida have been off the charts. We invested in a deal recently in Tampa, which is, one of the fastest growing rental markets. So a lot in Florida, a lot in the Southeast, but we've also done transactions in places like Los Angeles, right? Where it's more challenging to build and there's not a lot of land and there's not a lot of ability to kind of expand that footprint in like core Los Angeles. So from a supply and demand perspective, we think that feels really good. We've done things in the Midwest, right? There's an interesting dynamic happening in the Midwest right now where developers are not going into that market because you don't have the population growth, you don't have the job growth. A lot of that, again, is in the Southeast. So you're seeing a lot more developers in the Southeast and in Texas. Well, the reality is that that's going to start to create some pressures on supply and demand in the Midwest, right? Where there's not new supply that's coming online, but there's still, a heck of a lot of people who live there and have current jobs there. So, there's a lot of different markets that we like, but for different reasons, right? When you think about Texas and Florida and the Southeast, you're thinking about job creation, which is going to lead to population growth, right? When you're thinking about other markets where there's not that job creation, that population growth, it's a supply and demand story, right? And is the housing stock or, the industrial stock becoming obsolete? And is there demand for that product? So different markets kind of have different drivers. But fundamentally, it comes down to supply and demand and basis.
I want to put you on the hot seat a little bit, Jilliene, to have a little bit of a debate here about just comparing, because this is something that we get a lot of questions about. We've done syndications in the past to a limited degree, and from time to time may have some, but our core business is really in assisting people building their own personal portfolio. I think there's a lot of, it's really a cost benefit ratio and a decision everyone needs to make. Am I better off owning a physical asset or putting money into some type of fund? I think what we find is a lot of our investors end up doing both potentially, but they maybe start investing in an actual physical asset. I tend to like that as a starting point for most people. I mean, a lot of our investors are looking to be passive. And so there's an argument to be made about like, can you truly be passive and should you be in the type of asset that you're investing in? But I do think there's a lot of benefits of owning a physical asset if you're using leverage to have complete control of that, using the tax benefits, using leverage. If you had to compare and contrast, the benefits of investing in, say, a syndication or crowdfunding deal versus owning a physical asset, what would you say to someone that's considering doing either or?
Fundamentally, I think it comes down to how do you want to spend your time, right? If you want to spend your time getting in the nitty gritty, you have a reason to own a physical asset on your own. If you don't want to spend your time getting in the nitty gritty and you really want to be more passive and more hands off, I think, syndication probably makes more sense. I probably have the opposite perspective of yours, which is I think investors are better to start in syndication so they can get diversification. One of the challenges if you're just starting and you buy your first single family home, well, you got one tenant, right? If that one tenant decides not to pay you, or you're in a market like, in Los Angeles as an example, there's still COVID rent relief, right? Where that tenant potentially has not been paying you now for over 2 years. Who knows if, the government is paying you or not, because there's a huge backlog of that money getting out. That starts to get really scary, right? Where you have kind of single concentration risk. But there's a lot of investors who prefer to be active, right? If you're a person who wants to stay in control, a person who wants to be really deep in the details and be really active, you're better off to go acquire that real estate yourself. If you're, a lot of the investors on the Realty Mogul platform we find are really busy professionals. So they're attorneys, they're doctors, they're small business owners. They don't really have the time, to go and be active, but they still want the exposure to real estate. So at the end of the day, I think it comes down to time.
Oh, that's a very valid point. I love that you said that. And absolutely, it's something I think a lot of our investors that come in and build a portfolio. And the goal, of course, would be to buy multiple properties across multiple markets. I use that same example. So many people, obviously, you don't want your entire portfolio to be reliant on one tenant and one income producing property. That's why it's important to build scale your portfolio across different asset classes and different markets. Let's talk a little bit about the crowdfunding. Is when you say the term crowdfunding versus syndication, are those terms interchangeable? Is there any distinct differences that we need to make the audience aware of?
I think they're interchangeable. Just traditionally, syndication is offline and crowdfunding is online, but it's the same concept.
Okay, and so you're investing with a handful of other people. You're basically a limited partner in the deal. Is that how it's structured? And I mean, there's different, obviously, investment opportunities, timelines. What would you say a typical timeline is, and typical projected returns, just if you had to say your average deal?
Yeah, I mean, every deal is slightly different, right? And it's free to create an account on our website. So feel free to, go create an account and sort of browse, and you'll start seeing, deals come out so you can get a feel. But every deal is different. Typically, every transaction will have an estimated hold period. It could be 3 years, 5 years, 7 years, 10 years. That's usually about what we see on the estimated hold periods. And the projected rate of returns vary really widely. And you can think about it kind of like core, value add, and opportunistic, right? So an opportunistic deal might be a really heavy, construction of an asset where it's vacant. They're going to go do a ton of construction and then they're going to look to put a new tenant in. It could also be a ground up development, right? Where they're building ground up. Typically opportunistic deals, you'll see projected returns in the 18 to 20% IRR. That's sort of the right risk profile for that kind of opportunistic deal. Next down, kind of the risk reward channel, is value add deals. These are existing assets, but they have some element of value add, right? Renovations, re-tenanting. In the case of an apartment building, it might be anywhere from 5,000 a unit to 20,000 a unit that's going to be renovated. So new carpet, new paint, new appliances, new backsplashes, new countertops, new cabinets, etc. Most value add deals today are around a 14 to 16% IRR projected, I would say. And then further down the curve, you've got more core deals, tend to be more stabilized, tend to be in more primary markets. And core deals today are kind of in the 11 to 14% IRR range, I'd say, widely. Obviously, there's risk. No returns are guaranteed. So just throwing those disclaimers out. But that's kind of generally, what we see as you look across core, value add, and opportunistic.
Got it. And so when we talk about your IRR, just for someone that's not familiar with that, that's your internal rate of return. That's really, if I'm defining this appropriately, this would be like your return at the end of the deal. After you get your money back, you're factoring in all the expenses of sale. And but do you offer a preferred return on an annual basis in addition to that, or how are things typically structured?
Yeah, typically there is a preferred return on most of the investments. Again, you'd have to look on our website at each specific transaction to get the specifics of that one. But more often than not, there's a 7 or 8% preferred return. Prior to the run in interest rates, it was easier to pay that current, right? So that would be paid in, if you invest in a deal, this year, that would start getting paid out this year. It's pretty hard to generate 7 or 8% cash on cash yields in today's market. So if you had a preferred return of 7 or 8%, maybe 4 or 5% of that will be paid current, and then the remainder will be accrued until the property has enough cash flow to pay that out.
And so preferred return is just what the investor is basically, they're being paid first before the general partners or syndicators are being paid. That's what they're being paid first, that preferred return, and then the IRR is more of a projected anticipated return at the completion of the deal. Is that accurate?
Accurate. And if the general partner is putting capital into the transaction, they're typically getting pari passu on their capital as well. So if the general partner brings $1 million into the deal, limited partners bring $9 million into the deal, for every dollar that comes out of the property, 1/10 of that will go to the general partner, 9/10 of that will go to the limited partner on the preferred return.
Okay. Now, you mentioned earlier, I just want to step into some of your deals here. You mentioned that, talking about some of them are going into and buying, groups of single family homes. And we've definitely seen that with some of our local teams. They'll bring us properties, and then the next day they'll be like, oh, by the way, they're gone. The big money and the syndications and the crowdfunding have stepped in a lot since the Great Recession, and we've seen them buying up single families. Is this a trend that you expect to continue obviously right now it will, but do you see it continuing even after the next downturn, whenever that is, happens in the housing market? Or do you think it's something that's going to push out some of the investors, some of the big money investors, as they get going?
I think that it will continue. I mean, when you think about, there's two different ways to think about single family, homes for rent. One is true built single family homes for rent, which effectively they're all next to each other. They're all in one community. They have shared amenities. that really doesn't operate much differently than a multifamily apartment building, right? You can have property management on site, you can have maintenance on site, you can operate it out of a leasing office. I mean, that to me is just multifamily with more land, right? And sort of standalone units with attached garages. So that really operates very similar to kind of this institutional asset class that has been owned and managed by institutional investors for a long time. There's the other side of single family homes for rent, which is maybe you go buy 100 homes in Tucson, Arizona, as an example, but they're not all in one community together. They're spread out over, 5 or 10 miles. They don't share a pool. They don't share a clubhouse. They don't share a gym, et cetera. That's a lot harder to manage. So I think that you're going to see, institutional investors having a lot more demand for the communities, the pre-built communities, as opposed to, disparate single family homes all across a certain market.
I want to talk about a little bit of the potential risks of investing in, crowdfunding or syndications. I mean, I think this really comes down to kind of like we were talking about vetting so maybe we can tie this into how you vet your partners, but is really the operator and of course the deal itself. But we have seen syndications in the past that have gone south. The operator or the project goes belly up. You have to, as a limited partner, it's like, what protections do you have? I mean, it seems like we're aware of this one syndication that we knew of some clients that were involved in, and they went bankrupt, and then still unwinding, years later, going through the bankruptcy, and it doesn't look promising that they'll receive any capital back. So, I mean, that is a potential risk. I mean, and how do you mitigate those risks? Any other risks that you would care to mention to the audience?
Yeah, I think you're spot on. Zach, there's real risk in real estate investing, right? And if you're going to look to project, 14, 15, 16, 17, 18, 19% returns, like you can't generate that kind of return without having real risk, right? At both the operator level, the real estate level, the location level. A lot of people talk about real estate being location, location, location. I think syndication is all about people, people, people. Right? So who is the general partner, right? What is their level of expertise? What is their level of experience? Have they done business in that market before? Have they executed against a business plan that looks like that before? All really critical questions that I think investors should be and need to be asking before they get a level of comfort to invest in a transaction. We have minimum qualifications for every real estate company that does business on the Realty Mogul platform. So we're running background checks, we're running criminal checks, we're running reference checks to get to know the people, right? We're meeting the people, we're on site at the real estate. So, we're actually verifying that property actually exists, right? So that there's no, risk of fraud, or that deal doesn't actually exist, or that piece of real estate doesn't exist. What we can't do is vet every single real risk of the underlying real estate, right? Because there's an immeasurable amount, right? There's macroeconomic risk, there's microeconomic risk. But what we do is try and make sure that there's nothing glaring that is, completely unrealistic, right? If you are in a market today where the average rental rate is $1,000 for a 1-bedroom, and you come to us and you say you're going to get $5,000 for a 1-bedroom, like we know that that's materially unrealistic, right? So we're looking for things like that. But I think most importantly, through the background checks and the criminal checks and the reference checks, we're really trying to ensure that the people that we're doing business with have a history and a track record. Not to say that they can overcome all macro risk or all economic risk, but that they can have a good shot of executing against the business plan that they're putting forth.
Excellent. And as the property progresses, also making sure that milestones are being met and things like this to keep them in check as well, right?
Right.
You mentioned kind of the different variations you have, like the core model, the growth model, and those things. How, as an investor, do you recommend people, pick which one to go with? Because I mean, a lot of people look and they say, well, that one has 18%, this one has 11%. Why would I go with the 11% one? So how do you recommend people look at deals and decide which route is the best one to take for them?
I think it starts with getting good clarity about what are your goals, right? Are your goals that you're looking for, income on a relatively, consistent basis because you're a retiree and you need income? Are your goals to have no income and have only back-end appreciation because you don't want to get taxed as income because you already have enough income? And also, what's your risk appetite, right? Are you willing to buy into the riskiest transaction, or would you rather buy into something that's, still risky, but slightly less risky, right? As a general rule of thumb, the higher the projected return, the higher the risk of the transaction, right? So I think that once an investor gets clarity on what are their goals and what level of comfort, do they have on the risk profile, then they can start to sort deals and contrast and compare deals, for their own kind of personal ability to sleep well at night, right?
Yeah. What about on the tax side? Is this a scenario? What are kind of some of the tax benefits? My favorite thing about investing in real estate in general is just, it's the tax side of things. But what about on the syndications? I mean, in some cases, are you guys doing cost segregation studies and allowing accelerated depreciation to clients, or is that something that's not so realistic? And what other tax benefits are available through crowdfunding?
Yeah, so for the individual deals, which are open to accredited investors, those investors will get depreciation on their K1. So they will have the ability to write off depreciation through their K1. Some transactions will do cost seg and will do accelerated depreciation. That's not true of all deals. We've also done some opportunity zone transactions. So for investors who have, capital gains that they want to defer, we've got some opportunity zone transactions that they can also invest into. So between, writing off depreciation and opportunity zone deals, those are the two big kind of tax benefits that we see.
That's outstanding. We haven't covered opportunity zones a lot. We've talked a lot about cost seg and depreciation in general. Do you mind just talking briefly about what is an opportunity zone and how that kind of can be a tax play for someone?
Sure. So, the regulations changed as of January 1st of 2022, but effectively the government designated all of these locations as opportunity zones where they were trying to incentivize additional investment. So if you invest in an opportunity zone, and a lot of real estate entrepreneurs have taken advantage of this and are, building ground up development, they're investing in these markets. If you hold that investment for 10 years, you can get sort of the full benefit of the opportunity zone, where it allows you to defer taxes on capital gains. And those capital gains don't have to come from real estate. They could come from, the sale of a business or, other areas. So if you think about like a 1031 exchange, that had to come from real estate. With the opportunity zones, those capital gains can come from, other areas, not just real estate. And there's some benefits after 5 years, but the max benefit is holding that for over 10 years.
All right. Well, Jilliene, thank you so much for joining us today. Jilliene is the founder and CEO of Realty Mogul. The website is realtymogul.com, realtymogul.com. Jilliene, is there anything you want to leave our listeners with today?
Just get involved, learn a lot. I love what you guys do, and it's an amazing service on the education side. So, get involved. The best way to learn real estate is to get in real estate.
I love it. Take action. I have one more quick question for you, Jilliene, for just in the crazy world that we're living in right now with stocks and inflation and interest rates. I mean, obviously we're all bullish for real estate in general. However you're participating, the beautiful thing is there's many ways to participate in real estate. If someone is just considering real estate versus stocks, I mean, in the quickest answer that you can, what are some reasons to invest in real estate alongside or instead of other things that are out there in the market?
Look, I think if you have a long time horizon, real estate has proven time and time again to be one of the best performing asset classes. And I just look at history. There was a couple of properties that I looked at buying over 10 years ago now, and like every single one, no matter what the basis was 10 years ago, would have made sense today. So it's if you look at history and you look at the performance over history, real estate has been just a phenomenal place to invest. Wealthy people make their money in all kinds of ways, and they choose to keep their money in real estate. So, there's a lesson in that.
I love it.
It's worked and it will continue to work. So I really appreciate it. Once again, Jilliane's website is realtymogul.com. You can check us out at renttoretirement.com. That's renttoretirement.com. Really appreciate you going to your podcast platform and leaving us a review there. Also, if you have any questions, email them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Thanks for joining us today, Jilliene, and to everybody else, see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.